So firstly, a big thanks to the team for setting up this panel. As you can see, while broadly we use the term investors, there is a certain nuance that every person, every organization on this panel is bringing in, and uh, you- with this discussion, in some sense, we would like you know to bring out that nuance, and especially in the theme around which we want to discuss, which is while maintaining inclusion, how do you also ensure that you are scaling and you're growing sustainably so that the impact that you create is also in some sense sustainable in the long term. Thanks a lot again for joining today for this. I promise I'll speak less. Uh, so I'll actually we'll just go from probably right to left. Anand, we'll want to start with you. Um, as he, and you are definitely been looking at fintech quite closely. What would be your view of inclusion in general or impact? As a space that startups should focus
Sure.
on.
I'll touch upon that not only as a VC, because prior to being a VC, I was a operator in what broadly people have termed as the inclusion space. I used to head a company for South Asia in all the developing zone. If you talk about Malaysia, Indonesia, Bangladesh, Sri Lanka, even Pakistan, actually, where I could never go for micro insurance and microfinance. This is a company called Milvik. And after that, I entered VC. One learning for me from all this was, and there, as a pure blood VC, we were very different from the impact funds. So the answer could be different for the impact fund, is that business sustainability and the scalable models, they have to be the first lens to most of the financial services products before inclusion. That was my learning, and I'll tell you why. Because multiple model of inclusions uh, where you prioritized inclusion over the business sustainability did fizzle out and could not create the impact. But the reverse, where you thought about sustainability and the model and the scalability of the model. Think about multiple such models in India. Think about the microfinance from 2006 when Mohammed Yunus started it. If you focus on that scale and sustainability, given the developing world and the opportunity slivers that you have, you will end up creating inclusion as a collateral rather than trying to do the other way around. So as a VC model, our focus will always remain on that. But when I look back into the companies, for example, Kulin is here, like how we are underwriting SMBs, we did not think about Onsurity from the inclusion angle, but more as a more capitalistic, let's say, scalable, large business angle. But I'm pretty sure that it will end up creating an impact on insurance, which many inclusion focused models led by nationalized insurance companies will not be able to do. I'm making a very bold statement, but we are into taking bold bets. But that's where our lens will always stay.
So I think now just want to add a different lens. I think Rakesh, you'll probably bring that as an impact investor. MSTF has a mandate in some sense, right? That you're looking at the urban poor. So when you are looking at evaluating investments, how do you actually go about it? How do you what makes you comfortable that okay, this is something which is going to be, as per the mandate of the foundation?
I think, as Anand mentioned, I don't think it changes anything meaningfully whether we are evaluating a business from a VC angle or from an impact perspective. Sustainability is the core of any entrepreneur we'll be backing up. Of course, when we are seeing it from a lens of impact, the matrix changes. And from that, the dual KPI matrix comes into play. One is the financial matrix, which any commercial, conventional investor will look at it, and the other is the impact matrix. Since we are a 501c3 private foundation operating in country, so most of the, or in fact, all the investments that we make are part of our program-related investments. So by virtue of that, any business that we evaluate has to kind of fulfill all the impact matrices, and the core matrices as part of our financial inclusion would be, while evaluating, would be in terms of number of the new to credit customers that are being onboarded, the percentage of borrowers coming from the low household income, and any investment that we make, all the founders are mandated to kind of underwrite charitability framework with us, which mandates all the specific social obligations that any enterprise would be required to make. In terms of assessment, of course, the impact matrix takes the center stage, and before getting into the specifics of any business model while evaluating, we always go with the founder to understand their theory of change from the financial inclusion perspective. What are they trying to solve for, be it on the credit side, be it on the savings product side, be it on the insurance side. If their theory of change is centered around marginally poorer people or financially excluded population, of course, that ticks the box. And rest of the things, as Anand mentioned, is exactly the same for us. The only one additional point that, at least at the Dell Foundation, that we very actively work upon is, since we are not VCs where we would be making 10, 15 investments every year, we are kind of possibly doing 4 or 5 investments in a year. So our active giving management is very, very intensive. We are very, very deeply engaged with the founders, not only at the time of investment, but after the investment also. So for the first 4 or 5 years of our investment, we are very deeply entrenched with the founders.
Thanks a lot, Rakesh. So we'll come to you, Lavanya. So Trifecta, you're definitely looking at equity investments, but there are also the alternative debt kind of investments. How do you evaluate things? Is it slightly different from how, and you're definitely looking at growth, right? That's a stage where you're coming in. How your evaluation probably be different from, or would it be different from something what an Anand or a Rakesh should do?
So I'll give you a two-part answer for the venture debt piece and the equity piece. So Trifecta has, on the early stage side, a venture debt series of funds. We're on Fund 4 now, where we like to support, broad-based new economy companies. But it so happened, I was pulling this for you, actually, Sandeep, 27% of our deal count has gone to financial services or fintech. And that's actually 37% by value of the funds deployed so far. So it's a very large piece of our business. And I think for especially any lending business, right, your liability side is critical. And venture debt comes with a certain cost of capital, which is anywhere from, say, 13 to 15, 16%. So at a certain phase in the life of a lending business, that will make sense. At a different point in the journey, when you're more mature and then you can build a much more lower cost liability side, it will not make sense. So stability in the set of underwriting metrics is one marker. Another is really, is there very good equity support? Because ultimately, for more and more raw material on the debt side to come in, you need very good equity sponsors. And I think on the impact side, definitely we've started measuring a lot more metrics as we've grown and scaled. And I think in a country where, there's a big new to credit population, there's also a bunch of underserved SMEs. Rural credit I was looking at is less than 10%. So there's so many ways in which under-penetration shows up that we believe in every segment we've invested in, there's different ways to capture that impact. On the equity side, about 15% of our corpus has gone into financial services and fintech. It's a little bit lower than we thought also because valuations were quite crazy in the last 3-year period on the growth side. They seem to be moderating a little bit, though not entirely, because I think in this country, for good, high-quality businesses and founders, there'll always be those few select investors are willing to pay a very full price. So it's about 15% of our growth equity corpus. And there we've looked at lending as a very core piece. And we've looked at balance sheet focused lending because we believe truly that is where large scale growth stage impact can be created.
Thanks. So you're saying that you are going to look at those metrics for inclusion, but it's more from an opportunity perspective, or is it also from a risk perspective?
So that's a good question. I think sometimes when we use the inclusion lens, right, the early metrics may not be indicative of truly the potential of that segment. So for example, we've made an investment in a company called Five, which is helping young working professionals augment their quality of life with insurance, with the ability to make hospital payments, with the ability to pay school fees and get a better future for their children, all through unsecured credit. So if you look at just the profile of customers, it looks like it's very risky. It looks like you'll have to charge them really high rates of interest. But if we actually look at this borrower profile that FIBE has managed to find in its underwriting funnel through all their metrics, it's actually a very reasonable NPA. It's actually sitting at a very nice ROA. And so the early metrics that you would look at for this type of segment may not be indicative truly of the credit quality and repayment potential and the potential then to create impact through what it is these borrowers are funding with these payments.
Thanks, Lavanya, for that. So from investor, I'll come to the operator perspective. So Kulin, you have 3 investors sitting here. I mean, how do you actually go about asking money from each one of them? Or are you going to be confused about it?
He used to be an investor, by the way.
Yeah, so one of them is already there with us. So I think from our perspective, right, Onsurity started with the thought process that we never wanted to kind of build anything which is not a category creator, right? We come across very few examples of category creators, right? And realized that if you're not creating a category, then you will land up like a lot of them in either burning money behind acquisition. You will take a lot of time to scale because there's just so much of competition, right? So we said that if we are doing something, it has to be category creation or better not do anything, right? And I think that's where we stumbled upon the fact that, hey, what is the one instrument that is, extremely underserved in India, and that is insurance, right? Second is, by the way, I always actually start with this. How many people out here have at least some insurance? Great. How many of you have an insurance from your, from your company or organization? Right? How many of you actually don't have it? Yeah. Okay. We are trying to make sure that when we sit in some other panel, a lot of more hands goes up, right? Because in most of the panels where we sit, the hands are normally down, right? There are 63 million SMEs, and only 5% of them provide any kind of a health benefit today, right? Who are these SMEs? This could be right from an ITS company or to a small karkhana, to a small agency, anyone, right? And who are the people who are working out there? People like us, right? Most of them don't have any kind of an insurance product. And when they don't have an insurance product, there are 2 ways to solve for it, right? Either you create a B2C model, right? Where you will have to cut through, online players, offline players, right? Multiple kind of intermediaries. Or else you could actually go behind a segment of people who want to provide a product like this, but don't know where to source it from, don't know whether this works or not, because everyone out here, while taking an insurance, has only one question: will I get claims or not, right? And the second question that as an employer has is the fact that if I don't have any claims, will you give me money back or not, right? Because I'm paying my hard-earned money, so are you going to give me money back or not, right? We said we'll need to solve all of these problems, right? Make it affordable, make it accessible, and make it engaging, right? So at Onsurity, basically we said that if we do these 3 things, we will be able to go behind a completely non-existing market. We don't have to, provide discounts. We don't have to discount our rates just to kind of, go out there to acquire a customer, right? And if you go to see, in many ways, it's a B2B2C play for us, right? Where we are then able to kind of go ahead and create a lot of value for the cost of acquisition that we do today, right? And that was the story to the investors, right? Low cost of acquisition, completely underserved market, right? A market which can be, very interestingly be acquired if you have the right GTM, right? And this is a market where you can actually control the experience. And this is a product where you can actually control the experience. So we combined health, wellness, and insurance as a monthly subscription, right? And today we're supporting close to about 8,000 SMEs and about 1.5 million users.
Wonderful, wonderful. And you mentioned the partnerships-led approach, so I think probably I'll just start there. I mean, how do you think you went on to build this differently, build the product differently, or even the organization and all? I mean, how did you build this differently? Because you have sort of have this partnerships first kind of an approach, right? How would it change? Just want to
There are always two options for entrepreneurs, right? Either you build everything right from scratch, right? Or you partner with the right folks and, make sure that you're doing a better job than anyone else is doing. We realized that our core competency was always going to be our ability to reach out to the market, our ability to, curate the right products, right? So we didn't need to be a manufacturer for that. So we had the right insurance partners where we kind of ensured that we made them understand how we are looking at market, how we are more of a collaboration and not competing with anyone else whom they are working with, right? And why they should be kind of supporting us. So that was a partnership-led approach from a product perspective. From a health and wellness perspective, there are again two options. Either we have our own team of labs who will go and collect blood samples for health checkups, or we onboard 25 doctors and do teleconsultations. We realized that that's not where we would want to spend our money. So we partner with the right folks, but we ensured that the experience was an Onsurity experience, right? So we would consume the APIs, right? But how to discover, how to book, right? The entire experience around it was something that was led by Onsurity, right? And the last one, from a GTM perspective, we can spend a lot of performance marketing dollars. They will not yield the right results. But there are a lot of, unique ways of going and acquiring your customers. One of the ones that we kind of tried out and we have kind of, been successful at is creating these affiliate partnerships. What are these affiliate partnerships? For example, you have a food delivery platform, which has kind of aggregated restaurants, cafes, and these are all SMEs. So they have taken the opportunity to aggregate a fragmented sector. We would work along with these platforms and create a program for them and help them to approach approach their supply, right? And create an entire program saying that, hey, you know what, if you want to take care of your business, right? Here is a partner like Onsurity with whom we have created a Suraksha program or a protection program, right? And you can take their services, right? And this is completely vetted by this partner. So one of the examples that I can give is that we work with Tally today, where Tally has multiple distribution partners, and we've created a co-branded program with Tally, powered by Onsurity, where we have created a completely homogenized product for them, and any Tally distributor can actually take this program to ensure that they give the health and wellness partnerships to their employees. For us, it became a great thing because one, we are working with Tally, right? The distributors of Tally trust Tally for the choice. For us, it becomes a low CAC because we already have established a connect. So what we would have invested behind an MQL, right? We can actually convert that into an SQL, which is sales qualified leads, right? Which brings down our cost of acquisition. Yeah.
Interesting. I mean, not just looking at employer kind of thing, right? But just going beyond that.
One of the other things that we obviously do is that we have also now started working with, say, lending platforms for their SMEs, right? So these are some of the things that we keep doing, and hopefully a few of you guys would have seen our product on Cred. Yeah, this is not a sales pitch, but we have enabled a cyber insurance kind of a product on Cred. So yeah, so we keep doing these kind of partnerships to reach out to the market.
Thanks for that, Kulin. Just one question, and I'll guess any of you, if you have views on this. How do you know that, maybe when you're looking at your portfolio startups, when you are looking at your own startup, how do you know that, well, ab gaadi chal padi hai, aur al chalti rahegi, right? I think that's how I'm looking at, profit and scale, right? So, I mean, if you can give some examples when probably one of your portfolio, you realize that, okay,
I'm
now
just going to
this
add,
is going to,
as a founder, हमें कभी नहीं पता चलता कि गाड़ी चल पड़ी है या रुकने वाली है.
नहीं गाड़ी चल पड़ती है when you see a definite pull from the customer and customer is ready to pay money for that. In these two axes, if you are seeing, पता चल जाता है whether it's working, whether you have to push the product to the customer or whether there is a pull from at least a certain segment of customer. Next layer obviously comes where you know the ICP, whether it's large enough or not, and all that. That is a second degree question on whether that will map the valuation that we have given or not. That's the second degree question. But where a PMF has come is very, very clear. Once customer is like this angle, like customer are like one founder was telling me right now, he is in very different manufacturing setup की पहली बार लग रहा है कि customer is asking me अभी तक product क्यों नहीं आया, अभी तक why is it not there, versus we telling is sir RFP निकाल दो sir ये ले लो. That's when you start understanding that the PMF is there.
I'll just add, I think in India, since we are born with extra zeros because of our population, so any problem that any founder is trying to solve for, as long as the product market fit and the real problem does exist for which the founder is trying to solve for, scalability will not be a challenge in case if the PMF has been established, as Anand was also mentioning. The other angle from the impact side that we overlay while evaluating this founders or the business models is mainly that, I mean, while we are evaluating these businesses, we do not encourage the founders to talk about financial inclusion because they are talking to us as an impact investor. In case if the problem that they are solving for has an inherent DNA while designing the product, which will have products or services to cater to financially excluded population, then very unlikely that over the course of their journey, they will significantly kind of divert from their core principle of meeting the obligations to the financially excluded customers. So I think that's a very important parameter while we are evaluating the investments from the impact angle at the foundation.
I also think if you can build for Bharat at a cost structure that makes sense, then you can really be profitable. So for example, one of our portfolio companies, Ixigo, they do low cost flight booking, rail booking, and now bus as well. They became profitable at 1/10 the scale of when Make My Trip became profitable, which is the large OTA, the big giant in the space, right? And they did this by selling to the next billion users. They did this by selling tickets, and they did this by adding a layer of insurance. So cancellations was an issue, removing friction, providing utility, and providing a very seamless customer experience. So I think in our experience, if you can keep your cost structure such that the value being provided to the customer you're trying to include is high, then you can make good money in this country. And Meesho is another example of that. I'm sure many of you have heard of Meesho because it's a large, e-commerce company. After Flipkart and Amazon, it's the third largest. In my former life, when I was at Goldman, I wanted to make an investment in Meesho at 1/10 the valuation it is at now. And then my investment committee was laughing, saying, you all are trying to digitize the Tupperware lady. Will this ever work? What is this reseller model? Will they not get disintermediated over time? And the reality is that Meesho themselves matured with the market. The reseller model gave them the ability to reach a 2 billion GMV only having burnt $115 million. I had never seen that kind of horizontal e-commerce scale with that capital efficiency in any market that we had studied, right? They only did that through the reseller model. But then when the customers were ready to trust the platform directly, then they went direct to customer by raising a large round. But the journey was such that we kept our cost structure low to cater to that customer through a distribution channel they trusted that made sense for them. And when the customer evolves, you evolve with them. When the enabling infrastructure evolves, logistics, payments, when everything evolves, you can evolve with them. But I think ab initio, you have to serve them at a price point that makes sense.
Good, good. I think all different perspectives are interesting, including founder's perspective.
In a founder's perspective, that was obviously just a passing statement. But I think as an operator, right, every stage is, has a different, metrics to say, gaadi ruk gayi hai ya chal padi hai, right? Think about us as a train, right, which has no destination at all. It has to just keep running, right? You stop at one station, right? And you can only leave that station when you achieve a certain metrics, right? At one point, yes, the train is running because you have a great PMF, right? But the train will stop if you're not able to show, scalability. Then you go to the next station and then you will not be able to take forward if you're not showing profitability, right? Another one, another one, another one. So I think it's a mixed thing for, for operators where at every different stage, we will have to focus on different things to ascertain whether this model is working or not working, right? We've seen so many products where they've seen amazing initial traction where we've been at awe and saying, oh, wow, they have 20 million, stores using them, right? But where are those companies today? Because they will not be able to make any money out of those, products, right? So yeah, I think it's a continuous journey from an operator perspective. There is just no way that you know whether are you running or not. We've actually started implementing AI in a small way, not in a very big way. We are trying to kind of move a lot of our marketing functions to AI, a lot of basic content creation to AI. A lot of our claims part of it is also kind of being trained to kind of see how we can use AI out there. One of the things that we want to do is that how do we enable people's productivity with AI? We are experimenting actually saying that, for example, an entire calling function, right, or a sales qualification function, can we use AI for that where you don't need people to qualify a lead and the entire sales development function can actually, a part of it can actually become AI driven. So yeah, we are using AI in small pockets. Another thing that we're trying to do is that how can our tech teams use AI to debug themselves? How can our designers use AI to create basic designs on which then they can work and start. So AI is becoming more of a companion, not something that's going to replace someone, but definitely increase productivity. So if we are a team of 300 people, we hope to stay a team of 300 people, even if we kind of even if we double ourselves today. So I think that's what AI can do, increase productivity a lot.